Sure, we got a 4.9% unemployment rate, but if they're all part-time jobs, then your wages are down, and is it any wonder that people are in such dire straits, no matter how great the unemployment rate is? So it's those things I wanted to get to people. And when it comes to sound money, there's nothing more important than a return to the gold standard and return to gold and silver and using that in currency, because that simple thing, contrary to what all the mainstream pundits will say, that simple thing will rein in this massive debt system that we've got before us, and it'll bring back stability, the middle class, and a whole range of things.
Now, Kenneth, since January 1st, everyone has watched what's been going on in the stock market. It's pretty much a little bit of spike here and there, but pretty much it's going in the downward direction. And on the opposite side, everyone's watching gold. You can't miss it, is going up. And even if it goes down a few days or spikes here and there, it's been pretty steady. So I want to ask you, what's going on in 2016?
Yeah, one of the biggest things that is occurring is the fact that the central banks have run out of ammunition. They spent the last 5 years doing zero interest rates. They've done quantitative easing. They've done so many different types of programs to stimulate the economy. But there's a deep secret that most people don't realize. Out of all the tens of trillions of dollars that the global banks have printed under the guise of stimulus, they could not afford for that money to get into the general economy. It had to remain above the barrier in Wall Street, because if you expand the money supply like you have, you're going to create massive inflation, if not hyperinflation. So they had to keep the money velocity, the ability for that money to get down to prices and rising prices. Well, they've run out of ammunition now. And it really started, if you looked at the last, there's something that they call the Santa Claus rally. Usually, because of low volume, the investors can really run the stock market up during the final week of a year between Christmas and New Year's. This last year, the last 2 days of the year the market was down. And of course, the first 7 days of January down, and 17 out of 18 days were down. And even though we've had a dead cat bounce recently, everybody of any significance is knowing that we are going into a bear market in the stock market. Now, because of that, the real economy has been in shambles since 2008. And so central banks now bringing in something new. They're bringing in negative interest rates. And it's these negative interest rates that has the world on fire to get out of currencies, to get out of banks, to get out of the way of these central banks. And the only real safe haven they can do, because bonds are giving no yield, they're absolutely atrocious. The only thing that really is out there is gold. And there are some things that are coming up between now and April 19th that are going to really skyrocket gold well past 1,400 in the short term, and probably easily 2,000 to 3,000 by the end of the year.
Okay, 2,000 to 3,000 by the end of the year. I'm going to talk a little bit about Bo Polney. Came out here maybe a week ago, did a great interview, and he was talking about gold going right through the roof. He's a financial advisor, and I know you came on a call here recently, and you pretty much said maybe 3,000 by the end of the year. And again, you're not giving financial advice. I'm going to put that disclaimer out there. But as far as what you're seeing as an insider, can you kind of talk about why? Why is gold shooting up?
Sure. Right now, gold is spiking because there is so much buying pressure that the cartel can't drive it down like they used to. Now, here's something interesting that occurred on Friday, and this is a game changer. For most people who understand the stock markets, there is a way to buy gold through the paper markets, through an ETF, an exchange traded fund. It's either known as GLD for a gold fund or SLV for the silver fund. These are both run and managed by JP Morgan. Now, supposedly how this works is they can sell shares of the ETF, and JP Morgan is supposed to have the proper amount of physical gold in their vaults applicable for every share that's sold. Because they don't have to be audited, they've manipulated that thing for years. They've sold between 50 and 100 shares for every single ounce of gold they have in silver, but never has there been enough pressure and enough shortage in the open market for them to be able to get called out on it. Now the selling is going so fast and the demand is so great that we're not talking GLD, but there's another one run by a company called BlackRock, and it's the iShares Gold Fund. And this is another type of ETF. And on Friday, they issued a press release saying that they could no longer bring in new clients because they can't go out and buy the gold to support those new clients.
Okay, that's pretty much shocking. What you're saying, these the ETFs out there, the companies are saying they can't take any more clients because they can't get enough gold to back up the paper that they're selling. And now this, for myself, like a layperson, can you explain that? I mean, is there manipulation going on? What does this mean?
Yeah, there's manipulation. They use the paper markets, and when I say paper markets, anything that's dollar denominated that is not a physical thing. Real estate is not a paper market. Your stocks, your bonds, your 401ks, your mutual funds, these things are paper markets because all you're doing is you're buying a piece of paper and you're using dollars to buy it. You don't get something tangible back. You're hoping your broker has something in digital numbers on an account where you get a quarterly statement, and so that's it. It's all paper. And since it's all digital, they can manipulate it any way they want. So when I say the paper markets, if the SEC and the regulators do not audit these companies and these banks, then they can pretty much report anything they want, and they've been doing it. And one of the reasons why they do it is because once the central bank started doing this massive quantitative easing, the stimulus, trillions and trillions and trillions of dollars, there was going to be effect on the dollar. And gold and silver have always, from day one, been the balance to regulate the bankers from overextending the money supply. Well, if you're going to expand the money supply and the dollar so great, then gold is going to rise with it. So why didn't gold rise? The reason they did is because they control the price right now through the futures market, the COMEX and the London Gold Fix. And by controlling the price, and they can keep gold artificially down while they're protecting the dollar, which should actually be devalued, but it's gotten stronger. Now, there's two things that are coming between now and April 19th. Last weekend, India was putting to a vote to remove import duties on gold. 2 years ago, the people of India were buying so much gold that the central banks could not bring enough supply in. And there was also pressure from Washington telling the Indian government to keep that because too much of the gold is moving east. China's buying it. Russia's buying it. Even Kazakhstan's buying it. And of course, India, because they're the biggest holders of gold in the world. So India put on this import duty, massive import duty, and it slowed down the supply of gold coming into the country. So what did the people do? They said, well, heck with this. We're going to go buy silver. And last year, India was the biggest importer of silver in the entire world. They were going to do last weekend and vote to remove the import duties. That's still being tabled, but over the next couple of weeks, it should come in. When that happens, you're going to have 2 years of pent-up demand because Indians buy gold for everything, every ceremony, every holiday, every gift, and they use it for wealth. That's why a lot of the Indians wear so many gold necklaces, because it's built, each of the links is built to be a monetary value. And if they ever have to spend it, they can just rip off a link and use it for currency. So everybody holds their wealth. As a matter of fact, on average, every Indian family in the entire thing, and we're talking 1.4 billion people, they have on average 21 ounces of gold per family in the entire country. So that is coming in. And then April 19th, the Shanghai Gold Exchange is going to announce its own gold price. And that gold price is going to be yuan denominated, but right now the Shanghai Gold Exchange is the only physical gold market in the world, the only primary physical market in the world. The COMEX, London, they're a paper market. They deal with derivatives, they deal with futures contracts, but they don't actually deliver any gold, and they have hardly any gold in their vaults. Once China puts out a new gold price, it's going to cause a gambit. The U.S. and London are going to have to either try to arbitrage the price, i.e., what that means is If China is putting it out in the equivalent yuan of $3,000 per ounce US, if the COMEX right now is saying that gold is worth $1,265, all they would have to do to arbitrage is sell their physical gold for $3,000 and then buy it back at $1,250 from some poor sucker. But that's not going to work because the COMEX in London no longer have any gold. So once it comes out that the West doesn't have any gold, all of a sudden China now seizes control, and they're the ones who declare the daily gold price and the gold fix. And once that happens, then China is going to move to its next step. And the next step that China is going to do is it's going to demand a gold-backed trade note. So instead of trading dollars for yuan and having this huge, massive deficit, China is going to get enough countries that are willing, that have gold in their reserves, to say, we're going to put up gold in a neutral place, and it's going to be used for trade. We're not going to accept just plain fiat currency dollars. And then that's going to be the second step. And the third step finally is, once everybody's doing trade in gold, they're going to back currencies in gold. And to back currencies in gold, that's the long-term gold price. And if, as Bill Holter and Jim Sinclair have talked about, to be able to backstop the $227 trillion of global debt, the gold price to back a currency would have to be between $50,000 and $64,000 an ounce. So you have the short term, you have the medium term, and that with the gold trade note, and then you have the long term with the currencies. And that's going to probably happen unless some black swan comes along. It's going to happen between the next 2 months and 18 months.
What are we looking at when Shanghai comes out? What day are they coming out to step into the index or like the London fix or the Shanghai fix market, where they call the price on gold? When is that going to happen?
The last report that came out was unannounced sources told some high-level media sources April 19th.
Okay, that's real quick. That's in a couple months, less than a month and a half away.
45
we
days.
Don't have a lot of time is what it sounds like, number one. Number two, I love how you talked about the 1 gram, people can grab part of their necklace from India. I think you gave Harold Seitz a good idea here. The 1 gram necklace. to greet India into the market. I think it's awesome. But I want to go back to what you said about quantitative easing. Now, when you said quantitative easing, that kind of went over some people's heads. Is there a manipulation? Is that bank buying back their own stocks? Can you get into that just a little bit?
No, quantitative easing is a backdoor way for the central bank, i.e. the Federal Reserve in the U.S., the European Central Bank, ECB in Europe, the Bank of Japan in Japan, et cetera, et cetera. Quantitative easing is a way for the central bank to flood money into the private banks. JP Morgan, Bank of America, Citigroup, et cetera. It's a way to do that. And the way they do that is they willingly buy the toxic debts that each of these banks have. So they pay them cash, the banks, and they buy the toxic debt. Now, they don't ever get rid of the debt. All they do is shelve it. So it's out of sight, out of mind. It's pretty easy to do when you realize that the whole system is based on creating debt to create credit to print Federal Reserve notes, which means that it's not money, it's a debt. So if you are using debt-based instruments, i.e. dollars or euros or yen, if you're using those to buy paper assets like securities like Greek bonds, it doesn't matter if they go toxic, because if you can get them out of the system, all you got to do is tear it up. And that's what the Fed knows. But the Fed has to keep them on the balance sheet anyway, because there's always what's called a counterparty. Counterparty means that there's two entities involved. The Fed buys the toxic bonds. The Fed gives the banks money. That's what quantitative easing is all about. And it's taken trillions of dollars. But here's the problem. The problem is that the banks did not have to pay for what they did in 2008. For those who have seen The Big Short, that's exactly what happened. Okay? They had a very good idea in mortgage-backed securities using AAA-rated housing, and they got greedy because the money kept coming in and nobody was regulating them and nobody was stopping it, so they just split that off in what are called derivatives. Synthetic CDOs, for those who've seen the movie, is a derivative. It's a derivative of the original mortgage-backed security. And because nobody went to jail, because the government bailed them out, The banks didn't learn any lessons, not like the savings and loan scandal where thousands of bankers actually went to jail. I think it was the early 90s. So when the banks don't get punished for what they do and nobody goes to jail, you think they're going to stop the fraud? Not a chance. And so they've expanded it even greater. And that's why we have the national debt. We have, the Fed's balance sheet went from 800 billion to 4.6 trillion. So the Fed expanded their balance sheet. Deutsche Bank, which is on the cusp of insolvency. Now here's something else. See, there's a lot of black swans that are sitting out there. Deutsche Bank, which is the largest bank in Europe, it's the largest bank in Germany, the primary bank, and they are sitting on $70 trillion in derivatives. That is greater than the entire GDP of the entire world for a year. And if that bank goes, dominoes fall. And then once the European banks go, U.S. banks go, Japanese banks go. So we're back to the same thing we had in 2008, only think of it 100 times bigger because the debt is 100 times bigger.
That's amazing. Listen, I was going to ask this. We're talking paper like stocks, and if you go to a licensed series, financial advisor, broker, stockbroker, they're all going to say, keep on buying stock, keep on moving money into paper, not gold. And we're talking even annuities. And basically, without the disclaimer being with you that you're not a financial advisor, what do you know about this? What do you see? And really, should you only be putting 15%, 20% in gold, or is it time to move out of the paper and move into gold?
Well, I haven't been in paper since 2008. Nothing. Amen. I mean, I keep like $200 in a Forex currency trading account that I just do for fun. No intention of ever doing it. If I lose, I lose it. But it's just for fun, something to watch on the ticker today. But I am not in the stock markets. I'm not in the bond markets. I'm not in annuities. I'm in nothing with paper. The reason is because what backstops all that paper? The dollar. Every single thing is denominated in dollars. So it's not a matter of if the stock market goes down or the bond market goes down or your other paper assets go down. We are looking at the end of the dollar. The dollar is a purely fiat currency. And throughout history, whether you go back to the Dutch, whether you go to France, whether you go to the Great Britain during their empire days, Spain during the Spanish Armada days, they controlled the reserve currency. And they had fiat currencies at that time. The longest that a fiat currency has ever lasted has been right now, 44 years, 42, 43 years with the dollar. The average lifespan was 28 to 30. The only reason they've gotten away with it is because it's the reserve currency in this case. Once the dollar gets rejected, and here's how you can see the dollar's getting rejected. Yeah. So 3 years ago, the U.S. dollar, was used in 72% of all global trade. The Chinese yuan was used in 3% of all global trade. Now, move forward 3 years later, the dollar is now used in only 46% of global trade. The yuan is now at 13%.
But almost 2 years ago.
Once the yuan gets to that critical mass where it has a trade with them outside the dollar, then all the other countries can know that they can use other currencies other than the dollar. They will ship, and this is the key thing. Because countries have to use the dollar to buy oil, commodities, any resources out there, and it's the primary one used in trade. Because all these countries have to use the dollar, they hold reserves. There are of the $20 trillion we have in debt, 14 trillion of it is offshore. Okay, and once the world says we don't need to use the dollar for any of this, $14 trillion is going to come back to the United States. It's going to destroy the currency. And then the U.S. is going to be left holding the bag because we've instantly gone to a third world country.
Yeah, and I'm going to end it with this. First off, what are we looking at as far as your expert insider opinion? And I'm going to just stick it to you on this one and say I want something. How much are we looking at an ounce, in your opinion, by the end of the year, number one, and why gold, and why now, and why carat bars? So I loaded you up here.
Yeah. Just from everything that I've put together with a number of different analysts that I trust, Bull Pony, I liked his cycle theory and on the Shemitah, but he's more into looking at the cycles and where gold's going to go. That's absolutely fine. I'm taking into consideration a lot of different factors, including the dollar collapsing or negative interest rates or suddenly a rush. With that being said, I like the once we blow through $1,940, which was the last all-time high, it's going to get to 3,000 pretty quick. So I'm going to be conservative and say 3,000. It could go between 3 and 5,000. That depends on any geopolitical event. So, I mean, we're talking if World War starts out, if Deutsche Bank falls, if another country goes into hyperinflation, whatever, then everything's out the window. And this is definitely the year of the black swans. So I'm going to say 3,000, just put it out there. But even more importantly is there's not that much gold for people to get. It's not out there. And so anybody who hasn't bought gold over the last 7 years, 10 years that many of us have been talking about, the only way you're going to do it is in small quantities. And that's, I'm really glad that Karat Bars is taking their gram size and breaking it down into, 10th gram size, because what we're paying for a gram of gold today, feasibly within the next 4 to 5 months, is what you're going to pay for a 1/10 of a gram of gold. And if anybody's going to be able to afford anything, they're not going to be buying an ounce. They're not going to be buying a gram. They're going to have to be smaller denominations. And that's going to benefit pretty much everybody. And Karat Bars is going to be one of those places that, hey, they're going to have the gold and people are going to flock to it. That's something else that's happening. Real quick, Japan went into negative interest rates, and there are stories of safes, personal home safes, being bought off the shelves. All the 10,000 yen notes gone from the banks. So the Japanese people are finally pulling their money out of the banks, the savers, and they're desperately looking for a safe haven. How long until they wake up and start wanting gold? And you're going to see that all over the world, and it's just an open market of people who are desperately trying to look for somebody to say, where can I get my gold? And that's where, the Karat Bar affiliates are going to have a field day. It'd be like, oh, I'll take you, and I'll take you, and I'll take you. Oh, you want to join? Come on in.
Awesome, man. I want to thank you for coming out. I know it's Saturday night. I got you on short notice. I know you knew you weren't going to be on, you didn't think you were going to be on camera, but you are. You look great. And I think that this is recorded. It's going to go viral. It's going to be strong. Kenneth, I want to thank you personally and let you just go ahead and wrap it up with your insight and words of advice to us. You are a Karat Bars affiliate. I know you do a lot of radio shows. I know that someone called in on a radio show. I was told from a very good source that you had a nice big fat gold sale, just ice cold, from just somebody listening in on your radio show. So if you could wrap it up with insight for us as far as direction, as far as gold, and then we'll turn it back to China to wrap it up. Thank you for being on this call.
Thank you. One of the things that I found the most important, because my mom's been in affiliate marketing, multi-level marketing type thing for 15 years. And she said, this is not a business about money. This is a relationship business. It's most important that you understand and listen to the customer. Don't try to force them into seeing your vision. What you want to do is you want to listen to them and see how the Karat Bars vision can fill a need, solve a problem for them. Once you do that, then you got them hooked. I found the most of, all the negative things that people say, don't worry about that, shrug it off. And also be diligent, because, it's like planting a seed. It may not harvest today, it might not harvest in a month, but as they start hearing things going on with the financial world and the economy, they will remember you and they'll come back to you. And that's one, I just put things out there. That's why I write articles for you guys to use. I found the best way is sometimes people don't like to have the hard pressure, but if you throw things at them innocuously, then they'll start questioning, then they'll start having, and then they'll look for you.
I want to thank you. I want to turn it back to China. Are you still on China?